life cycle funds can be a much better alternative to the life insurance plans. In hybrid category, the major change will be in terms of the balanced advantage funds. They are a very popular category among investors, and this category will be renamed as dynamic asset allocation fund category. The residual portion of the hybrid funds earlier was invested mostly in cash and cash equivalents. Now, instead, they can invest in NVITs, gold as well as silver, and also exchange traded commodity derivatives. And here it can be only gold and silver. So you have liquidity, you have asset allocation, which is in line with your need, which is can have a higher growth in your initial years and reduce your equity component, increase your safety component by investing more in debt and gold towards the maturity period. You can use it for multiple life goals, like if you have a child who's just in class 1, so you can use a 10-year plan for a higher education. If you have a child who's in the 10th standard, you can take a 10-year plan planning their marriage expenses. And if you are somewhere in your 30s and you want to have a retirement corpus built, you can take a 30-year plan and use it for your retirement corpus.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
On the 26th of February, SEBI has come with a circular categorizing mutual funds, streamlining things to give better clarity to investors. But what comes with this categorization announcement is a very, very interesting product called the life cycle funds. We will go through this towards the end of this video, but you cannot miss this because this is a product which is going to give a big challenge to the life insurance schemes where investment is bundled with insurance. Life cycle funds can be a much better alternative to the life insurance plans. And with this categorization, the biggest highlight of this is going to be the life cycle funds. SEBI has categorized mutual fund schemes under 5 heads. One is the equity schemes, next is debt schemes, next is the hybrid schemes, next is the life cycle funds, and after that comes the other schemes where index, ETFs and fund of funds belong. There is also a change which has been brought in, the residual components, which means every mutual fund category has a mandate, which means for a large cap fund, minimum 80% of the investment has to be in a large cap stock. Similarly, every diversified category has certain mandates. So beyond this mandated limit, whatever is left is called the residual portion. This residual portion so far has been invested into cash and cash equivalents. Now, SEBI has allowed the residual portion to be invested in InvITs, gold and silver. By doing this, the equity funds, even through the residual portion, may be able to generate much better returns. Not only that, can also minimize the risk or manage risk effectively because different asset classes are coming into play where the risk mitigation as well as the return optimization may be taken care. There are a few other implementations with regards to the equity schemes category. Earlier, a fund could have, which means an AMC could have either value or a contra fund. Now, it is allowed clearly for every AMC to have a contra fund and a value fund separately. But it's very important for them to ensure there is not more than 50% overlap between these two categories, which means of the holdings of a value fund in an AMC, not more than 50% should be reflecting in the contra fund of the same AMC. Another change is in terms of the sectoral and thematic schemes. Sectoral and thematic schemes can be launched only in the category which is listed by AMFI with the approval of SEBI. Also, this sectoral and thematic funds cannot have more than 50% overlap with any of the other sectoral or thematic funds as well as none of the diversified equity schemes which they have. The only exception is a large cap fund. The overlap calculation is done every quarter and this is based on the daily overlap which has been there. The overlap which is between two schemes of a particular AMC has to be mentioned in the AMC's website. Is there a necessity to immediately address the overlap? No. SEBI is giving time. SEBI has given a 3 years time frame for AMCs to address the overlap limitations. In the first year, the overlap limitation should be taken care to the extent of 35%. In the second year, another 35% has to be adjusted. By the end of the third year, by doing the rest of the 30%, they have to 100% oblige to the limitations which has been specified by SEBI in the categorization. Let's get into the categorization specified by SEBI on the hybrid category. In hybrid category, the major change will be in terms of the balanced advantage funds. They are a very popular category among investors, and this category will be renamed as dynamic asset allocation fund category. So your schemes no more will be called balanced advantage funds, whereas they will be called dynamic asset allocation funds. The residual portion of the hybrid funds earlier was invested mostly in cash and cash equivalents. Now, instead, they can invest in NVITs, gold as well as silver, and also exchange traded commodity derivatives. And here it can be only gold and silver. Now let's look at the changes which are there in the debt category. In the debt category, all the long-term debt fund categories, which is the medium-term funds, the long-term bond funds, credit risk funds, etc., can invest their residual portion beyond the mandate in InvIT category. Also, debt funds can now come with sectoral debt funds, which focus on a particular sector's debt securities alone, but they can launch only if they have enough securities in the investment grade. There are also announcements for the fund of fund category. The fund of fund category can have three subdivisions. One can be purely active funds, the next can be passive funds, and the next will be a mix of active and passive, which would be called omni funds. When it comes to the overseas funds in the fund of fund category, the overseas fund of fund can be a country focused or a region focused. When it comes to the country focused fund of funds, it can be a fund which invests only in the US, it can be a fund which invests in Brazil, it can be a fund which focuses only on stocks of China. This is how the country focused funds would be. In the case of region focus, it can be Asia Pacific, it can be a region like the emerging market, it can be an European Union focused, the region focused fund of fund in the overseas category. So this is how the funds would be. In all the categories which we discussed, to clearly differentiate and for customer to avoid confusion, the beginning should be the name of the AMC followed by the name of the scheme. The name of the scheme in each category has to be uniform. It's like if it is a large cap fund, all the AMCs following their AMC name should have as large cap fund. Same is applicable for all the categories to have uniformity and to avoid confusion for an investor. Now let's come to the most important part. As we said in the beginning, the challenger for life insurance plans, that is the life cycle funds. While we say this, it's also important to mention there used to be a category called solution oriented funds, which is still existing, and these categories either used to focus on retirement or child education. Basically, these funds were hybrid funds. They mostly used to have a lock-in of 5 years. This is kind of getting removed while there are still applications from the industry asking SEBI to reconsider that. SEBI has announced this life cycle funds, which will actually take care of what was offered through the solution-oriented funds and much more than that. How will the lifestyle funds function? And how are they better than life insurance? Life cycle funds would have a maturity of 5 years and up to 30 years. The maturity or the period or the tenor of a life cycle fund will be in multiples of 5 years. It can be 5 years, 10 years, 15 years, 20 years, 25 years or 30 years. So as AMC can have 6 different lifestyle funds with varied tenors. Like for each tenor, like 5 year, 10 year and 15 year, they can have different funds, which means overall each AMC can have 6 such funds. The fund should have the AMC name and say life cycle fund and should be followed by the maturity year. If the particular scheme is a 5-year scheme launched in 2026 and matures in 5 years, the end of that scheme name should have 2031, which is the end of the tenor. Now, what's interesting is, in favor or in the interest of an investor, SEBI has clearly mentioned a glide path with a schedule specifying with time period how can the equity, debt and gold composition change for this? Which means if there is a 30-year maturity life cycle fund, in the beginning years or the first half of the years, the fund will be heavily invested in equity. So for a 30-year-old or a 30-year tenor life cycle fund, the first few years, beginning with 95% exposure, can go up to or come down to 50% until the fifth year. Starts with 95% exposure in equity and it comes down below 50% exposure in equity after the fifth year. So the balance amount is invested in debt, and all these schemes have the option of investing 0 to 10% in gold. An AMC can merge a particular lifestyle fund with the one with the nearest maturity when there is less than 1 year period left to the maturity, but this has to be done only with the consent of the investors. As the equity component changes and debt takes over and dominates in the later year period, because of this change in composition of the debt equity instruments, there is a question mark with regards to the taxation. This is still a gray area. SEBI is working on it and would come with a clarity on it. Now the bigger question, how does it become a better alternative to life insurance plan? Life insurance plans have life insurance cover as a mandatory part, while for a traditional plan or a ULIP plan, the insurance cover is not so significant, may not be so meaningful to an investor who is focused on investment, and a decent amount of the premium paid goes towards the cover that is for the mortality. For the mortality, there is a premium amount which goes and only the balance amount gets invested. But in this case of life cycle funds, you don't have any amount going towards any premium. The entire amount get invested. The investor also need not get worried about any volatility or risk factor with regards to the market, because the closer he is towards the maturity of the life cycle fund, his investment is mostly towards the debt and gold options. So the risk components get reduced and he has safeguarded all the growth towards the maturity period, so that whatever market fluctuations or uncertainties impact markets at the maturity time may not impact your fund because you are anyhow low on equity. Number two, these funds also have a exit load which is normally higher than a regular equity scheme, which generally do not have an exit load beyond 1 year. But these schemes have an exit load of 3% if exited before the first year, 2% if exited before the end of second year, and 1% if you exit before 36 months. After that, there is no exit load. When you invest in a life insurance scheme, you first of all cannot make an exit before 5 years. Even after 5 years when you exit, particularly from a traditional plan, so there is a surrender value which actually comes as a very low amount, very often much lesser than the amount which you have paid as premiums. Here what happens? The minimum maturity period is 5 years. So while you invest, if you are investing for a relatively shorter term or a medium term goal, choose the 5-year fund. And even here, after 3 years, you can exit without any exit load. Even if you want to, for some reason, exit in terms of an emergency, any point of time with whatever applicable exit load, you can exit, which is not possible in a life insurance scheme. Here also, we expect the taxation to be quite favorable to investors. So that also may not be a challenge. But given that the full amount what you have invested goes towards investments without anything kept aside for life cover, the growth of this investment is likely to be higher. Given the track record of life insurance ULIP plans versus mutual fund plans, where mutual funds always have had a significant outperformance over life insurance ULIPs, these schemes are also expected to deliver much better than your life insurance plans. So you have liquidity, you have asset allocation, which is in line with your need, which is can have a higher growth in your initial years and reduce your equity component, increase your safety component by investing more in debt and gold towards the maturity period. So a life cycle fund is available for you with complete flexibility, where you take a 30-year-old plan, you still have an option of using it like a 5-year plan, a 3-year plan, or a 10-year plan, or a 25-year plan, or 30-year plan where you exit at the year 30. All this without any clutches, no exit load at all after 3 years, and no penalty or surrender charges of any sort when you exit at any time after 3 years. You will have the efficient fund management skills of a fund manager seen here. You can probably expect a 10 to 12% or more of returns on an annualized basis. You can use it for multiple life goals, like if you have a child who's just in class 1, so you can use a 10-year plan for a higher education. If you have a child who's in the 10th standard, you can take a 10-year plan planning their marriage expenses. And if you are somewhere in your 30s and you want to have a retirement corpus built, you can take a 30-year plan and use it for your retirement corpus. So for various life stage goals, this particular life cycle fund comes as a very flexible, friendly, and most likely a better return generator than most other comparable product. We have told you about a solution which is going to be a killer product, which can be a challenger product for life insurance plans. How to structure this and which kind of funds, which kind of AMCs, which kind of category to choose is something which you may be puzzled about. We are here to help you. Reach out to us on the contact details mentioned here, and we are there to help you with customized solutions to meet all your financial goals.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.